Welcome to my channel. I'm the cover call guy, and today we'll be talking about the Federal Reserve officially ending quantitative tightening and what that means for cover call ETF and income investors like us. But before we get started, a legal disclaimer: this content is for informational and educational purposes only, and it's not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. Remember, I'm just some random idiot you found online, and I could be completely wrong. So, if you guys catch up on any financial news, the Federal Reserve, they've been doing quantitative tightening. That just means they've been sucking money out of um, the system. But now they're going back into quantitative easing. Another word for that is just money printing. And if you're a new investor, this might work in your favor or might not work in your favor. It just depends on how much cash you're willing to inject into the market. But for those who's been around at least the last 3, 4, at least maybe 5 years or more, you know what happened. In 2019, during the COVID, what did they do? They printed trillions. It was the market pumped, but what came after that, right? So we're gonna be going through the scenarios and what I think is going to happen. I feel like this is going to be another repeat. So this was the article. For those who want to Google it, just Google Federal Reserve quantitative easing, and a whole bunch of article will pop up. I just picked a random one because it's essentially all the same thing, right? So um, yeah, I'm going to break down my thesis. All right, so let's get started. PowerPoint. Let's see. All right, this is my confidential market analysis. All right, just keep this between us. All right, we're trying to get in before everybody else knows. All right, this the title is just the liquidity mirage. Basically, it's all a front. We need to know what to do now. Right, surviving the stealth pivot and the coming everything bubble 2.0. All right, phase one, the ignition. Right, as they start easing off the tightening policies and start actually quantitative easing, which just means starting up the printer again, right? While the official narrative focuses on fighting inflation, which they're always talking about, right? The data tells a different story, right? The data is saying, hey, look, it has nothing to do with inflation. They're pretty much just trying to pump money to keep the economy going. That's it. The Federal Reserve has quietly ended QT months ahead of schedule. They weren't supposed to do it until, I believe, end of like mid 2026. So we still had some way to go, but they stopped it. All right. So this is pretty much initiating a backdoor liquidity injection. So it means the economy is not really moving as the way it should, as we can see from the labor market. All right. Stealth QE explain. QE just means quantitative easing, which just means turning on that printer, right? If you go into your phone and you look for the memes or the GIF, however you want to say it, and you put federal or put POW, POWELL printer, and you see him just the meme cranking the printer, right? That's what it means. That is what happened during the start of COVID, and then we'll look what happened now, right? The market pumped, everybody had money, assets blew up, and it's still up, right? It got so expensive, but what's happening? Everything else also got more expensive from inflation, right? Everything was cheap when it first started, and now it's more expensive. All right, let's start from the beginning though. The repo blast. The Fed is pumping billions into the repo market, which just means where banks lend to each other, right, to prevent the plumbing of the financial system from seizing up. So a lot of regional banks are in trouble right now. Remember we talk about ELN swaps and all that stuff for cover call ETFs? Yeah, not a good thing right now. So that's why I always say, understand, like my previous video, understand what you're buying. Does it actually hold the underlying? Is it leverage? Is it swaps? What's actually happening? All right, reserve management. They don't call it QE. They call it reserve management purchase. Different title, same thing. The effect is the same. Massive liquidity injection into the banking sector, effectively debasing the currency to save the sovereign bond market. The liquidity connection, right? The S&P goes up as the Fed injects money. The correlation there, as you can see from the chart, as the Fed balance sheet expands, asset prices, which is purple, detach from fundamentals. If you guys are in the financial news sector, you're a long seasoned investor or you're a new investor, and you read up on what Warren Buffett says, right? The reason he has so much cash on the side is he thinks the market is way overvalued. To a certain extent, yes, but to a certain extent, no. And this is part of the reason why. As they keep printing money, everything goes up. The P ratio does not match anymore. That's what a lot of people worry about. But how does that affect us cover call ETF and income investors? I'll get to it. But let's start off with history rhymes 2019 versus 2025. September 2019, the repo market seized up, forcing the Fed to print billions months before COVID 19. This emergency plumbing fixed um, ignited the massive asset bubble that followed in 2020 to 2021. In December 2025, the exact same thing is happening, right? The same exact warning lights are flashing. The reverse repo facility is drained, and the Fed is back to buying T bills, treasury bills. We are entering the everything bubble 2.0 phase. This could be very dangerous for those who are just um, one. This is very dangerous for those who own no assets, and two, it can be very dangerous for those who are just um, entering and or buying leverage or using margin. And that's why I always warn about leverage and margin. What comes after leverage? Liquidate it. Be careful, know what you own, always have dry powder. All right, but how does that affect us, cover call ETF and income investors? Well, um, volatility is our friend, right? Is your friend. In a stealth QE environment, markets don't just go up. Literally, they become volatile. This uncertainty keeps the VIX elevated. What that means? Asset inflation, underlying stock rise with liquidity, high VIX, fear spikes option premiums, more payout, bigger payout for us. The strategy behind this: cover call ETFs sell this volatility as expensive insurance, generating massive yields. So for us income investors, this is great news. As long as you own assets, this is great news. The yield hunter's dilemma, right? We have the 10-year, the S&P 500 dividends, corp bonds, cover calls, and leverage incomes. All right, this is just my projected annual yields in the high volatility regime. As you can see, leverage and cover calls are outperforming everything. The trap, real versus nominal, right? Nominal gains shoot up, purchasing power shoot down. This is a warning, right? Inflation red will eventually eat the nominal gains. So we have to be careful that we are buying income producing assets. If you're not buying actual income producing assets, or you're over leveraged, or you're borrowing too much, right? You're using too much margin, you are eating away a lot of gains. This is my roadmap of what I think is going to happen. I'm basing it off the COVID timeline. Obviously, I could be completely wrong because eh, the the COVID timeline could it was like one of the first few things in history where modern pandemic happened. Here, it's more. It could be a slow burn or a black swan event could happen. We don't know. It could very well not be 2027. It could be 2028, 2029 when Trump exits the office and the next president comes and take it over. And then, all of this monetary policy could change. When the flood, which is right now the current status, Fed stops QT, liquidity enters via repos. That leads to the melt up, which is step two. Late 2025, equities rally, volatility spikes, maximum income. This is where we'll probably see the highest payout. And then I think we have to pay the bill, right? Mid 2026, inflation starts to resurge, real yields turn negative, and then what has to happen? The pivot from the Fed, right? 2027 rotates to hard assets, gold tips as the bubble bursts. So I think a lot of people will be hurt. For us income investors, if we're buying quality ETF, like I've always said, we should just buy the dip. We shouldn't be worrying about it too much, right? Create that. If we're in, for those who are in accumulation mode, right? Accumulation phase. Don't worry about a 30-40% cut in your monthly payout. That's fine. We are building up the stocks and our buffer zone to kind of mitigate this. So in the future, when we're actually ready to retire, we're like 10, 15, 20, 25% above every month of what we need to survive. And so, gold's good one. And tips just means treasury inflation protected securities. So real assets like such as what we own right now, right? Income producing assets. So we don't have to worry about um, something that's going to take away money from you, right? So you don't want to be owning but depreciating assets. Another thing for tips is well, a tip is basically a government bond, but I'm saying, you know, buy assets that pay you, not take your money away. All right, the barbell defense portfolio. For those who are new, the barbell is a term I made up. When I say barbell, right, when it's equal weights on both sides, you don't want to be working out with 20 pounds on one side and 5 pounds on one side, right? I don't think that's. I mean, you might be training for a certain way like that, but I'm talking about in general sense. For the most part, a barbell, right? You're not gonna bench or squat with 4 plates on one side and one on the other, right? You're not gonna do that. You're not gonna deadlift 4 plates on one side and 1 plate on the other, right? Right? No, that would make no sense. You're not gonna overhead press 4 plates on one side and 1 plate on the other. So that's what I mean by barbell. Is it's equal weights on both sides. So look at it from your portfolio setup. You want kind of equal weight on every single side. 40% cover call ETFs, 25% hard assets, gold commodities, 20% dividend aristocrat, 50% cash. So for new income investors, this is probably the best way. If you're new to investing in general, this is probably the best way, but I'm specifically talking about income investing. So you don't want to be all into cover call ETFs, especially if you're new, right? You're starting out. You don't want to see your portfolio just take a nosedive. That would really emotionally wreck you, right? For us seasoned investors, I would consider myself pretty seasoned. If my portfolio take a nosedive, I know what I own. I know why I bought it. I have high conviction in it. I don't think any of the companies I bought is going to go anywhere. I'm gonna go ahead and buy some more. But for you, the new income investor, you might want to be a little bit more diversified. You don't want to have 100% into straight cover call ETFs like I have. Um, this is a more balance, a defensive portfolio. Structural headwinds, right? Valuation risk. If the bubble bursts, high yields won't save you from a 30% drop in principal. That's the trade-off as income investors, right? Especially if you're investing in crypto, this will just this would just make you shrug, especially if you've been a long-term crypto investor. You can be like a 30% drop, whatever. That's another day, another hour. Right? Capped upside in a melt up, selling calls means you miss out on massive capital gains. Again, that's another trade-off for income investing. The inflation tax, nominal gains are deceptive. Ensure your real yield remains positive. And that's why I always say try to keep your real yield, like cover call ETFs, anything from 8 to 15%. Anything above 20, 25%, you have to start, digesting and breaking apart how they're making their yield. Questions answered. This is a short video. I'm going to make it nice and short. Leave it in the comment section, right? We're going to be discussing the roadmap for the next 24 months. We're going to start planning things out. As you know, if you're an American, if you live in America, Trump will be picking a new Fed chairman in mid-May, I believe, either mid-May, end of May, beginning of May. But Jerome Powell is going out. So Before I end the video, disclaimer, this is just my market analysis, not a financial advice. All right, this is just what I think is going to happen. I'm just basing it off what happened during COVID when they printed trillions, and the Fed is starting to start that process now, months ahead. So I think this is what's going to happen. If you like this video, if it was informative, educational, please subscribe, comment, like. Catch you guys in the next. Thanks for watching. Stay tuned.